When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name's Jeff Shade, and as always, I'm just here to ask the questions. But of course, the solid advice and words of wisdom come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing this weekend?
Doing good. How are you doing?
I'm doing great, thank you. I hope our listeners are doing well today, too. Once again, another great show lined up for us today. And, Jeff, we're going to sort of give another point to some of the things that I've been seeing on the Internet lately. And, again, we can't believe everything that we read on the Internet, we hear on the radio, or that we see on TV. What I'm reading at this point says, hey, inflation is getting more under control. We're getting close to 2%. We're looking at a rate cut, Fed rate cut around October of this year. Then we'll look for another one in December, totaling a half-point rate cut. Is that true or false? Is this just optimistic thinking, or is it an attempt to maybe mislead us?
Well, I think it's manipulation of the market. I think it's an attempt to mislead us, but it's been working. I mean, a year ago, or less than a year ago, in the fall, October-ish, we stopped. We had kind of our last rate hike, I believe it was last September. And then they said, you know what, we don't need another one because it looks like inflation's getting under control. And at that time, it was dropping okay. I mean, oil's getting a little bit more affordable. That puts less pressure on food. I think housing was probably the only thing that was really pressing forward with the inflation factor at that point. And then inflation started kind of going down. I think it was, if I look at the graph correctly, like July to October, the inflation was actually, the rate was starting to come down. And not that it was giving back anything, it just wasn't growing as fast. So the rate of increase was much lower. And then in October, they said, hey, we're not going to raise interest rates anymore because it looks like at least inflation's heading the right direction. Well, I tend to agree with the idea that, hey, you know what, maybe we can pause interest rates and see if the inflation continues, with its momentum to get smaller and smaller every month, if it could be okay for a couple months. Well, I mean, that worked for a minute, but just at that very point in time, inflation kind of started going back up again in November. Rather than say, hey, you know what, maybe we jumped a little quick, we might still have some rate increases. Powell comes out and says, hey, guess what? You know what? Let's do something to spur the market on because, October really, it bounced for a minute and then it started softening up at the end of the month. Actually, November did too. They said, you know what, we're going to have, I think we're going to price in 3 rate cuts next year. Getting close to, the year of a new election, getting towards the end of the year, everybody was, the market was starting to rally a little bit. It kind of tanked between, interestingly, between that July and October timeframe. The market was actually giving back a lot of those gains. I think the Fed wanted to stop the downtrend because, of course, the market finally looked like it was going to turn up again, even though, fundamentals weren't turning up. Income companies' earnings weren't really growing, but at least I guess the fear and the sell-off was kind of done, and they'd been easing the idea of raising interest rates. So, the economy was clipping pretty good as far as the employment was staying pretty steady, although prices were going up. That's not very good economically. But then all of a sudden, they priced in 3 rate decreases right away, and it was the November to remember. They priced them in, meaning, oh, well, if they lower rates, then that means next year all these companies are going to save on interest and they're going to make more money. Then JP Morgan and some of the other banks, Bank of America, are all saying, we think there's going to be 5 rate cuts. We think there's going to be 7. And, the Fed didn't say anything about it. They go like, well, we never said 7. So the market just rallies and keeps pumping up their own stock, especially the banks, the JP Morgans, the Bank of America's, Goldman Sachs, all these big bank/brokerage firms were buying their own stock. They actually got a big bailout from the government last year when Silicon Valley Bank went out of business and a few others. Actually, there were several other banks went out of business that we don't hear about. But there was a banking crisis where higher interest rates caused a lot of pressure on banks. They couldn't loan money at the high rates. They didn't have credit default swaps in place. A lot of them kind of sold off their hedges thinking that interest rate hikes were done. And then they got themselves in trouble. Well, even the big banks were in trouble because they've had a lot of loans in default. a lot of bad debt that they haven't been able to collect on, and now they can't loan money out because nobody wants to borrow at 7 or 8% to buy a house, or 10 or 12% for a commercial loan. So how are they going to make money? Well, the Fed starts kind of backdooring the money. They basically let them not pay back their Fed funds account. It used to have about $2 trillion in it, and the banks drew it down to, I think it was just in the maybe 800 billion range is what I heard a few months ago. So they're using Fed funds to kind of prop their own stock up and to not really pay back the Feds because they don't necessarily need to be paid back. They just said, here, we'll buy. So what the Fed did is they injected all this money into the banks starting last March in 2023. And in order to prop up the banks, March was kind of the first load of injected capital to the banks. All the while they're tightening for the rest of us, right? They're trying to take a little bit of money out. By the way, as far as the quantitative tightening, after the quantitative easing of $15 trillion or more, actually probably more than that. Some of it was probably legitimate deficit spending. But I think from the standpoint of QE money, just printing money since Obama got in office, it was like $8 trillion when he got in office. Now it's 34, I think now. So there's been a lot of money printing, but they were trying to take money out, raising interest rates and tightening the money supply. I don't believe they've even hit $1 trillion yet, last I checked. But they did allow the banks to basically offload all their bad debt to the Fed. The Fed basically gave the banks money, and the bank says, well, we can't really loan this money out. We have the money. Why not just buy our own stock? So they did. They bought NVIDIA. They bought Microsoft. They bought some of the big, power stocks that manipulate the index, and we had this market rebound. Now back to the inflation levels. Okay, so inflation is supposedly getting under control, so they don't have any rate decreases, even though they say they're going to decrease rates. Lower interest rates, 3 times, but then everybody else says 5 to 7. So they've priced all this in, like, okay, well, if they have 5 rate decreases and, next year rates are only at 3% instead of 5, or if they're at 2.5, let's just say it's, half of it's gone. If they can lower it that many times, some quarter point decreases and maybe a couple of half pointers, companies can borrow money at such a lower rate that they should be able to make money. Well, guess what? It didn't happen. They haven't lowered them yet at all. Yet there's still 7 of them supposedly priced in. And we still haven't seen earnings. We saw barely 1% growth in the earnings last year when the market went up between 20 and 40%, depending on what index you looked at. So the gains were just really manipulated by liquidity, which was really funneled through the banks. So there really was no quantitative tightening. In fact, there was a net quantitative easing. So no wonder there's a little bit of inflation coming back into the picture. Between December and now, the actual, and you can go online and read what's the true inflation. I think it's called trueinflation.com. You can see what the inflation numbers are. We're up 5% in half a year in actual inflation, even though the year-to-year numbers don't look that high. In other words, when last summer, between June and July, we were kind of peaking at the height of the inflation before we started giving some of those numbers back. We go back a year, and it was kind of a high point a year ago. So if we're kind of back up to that high point or a little bit higher this year, and we're only seeing this 3.1% growth rate over a high point. But from its low point, if we went back only 6 or 8 months, we'd see an annualized increase of maybe 4 or 5 or 6%. So they're kind of manipulating the numbers, not really manipulating the numbers. The thing is eventually if you keep using the same statistics, it will eventually catch up to you, and we'll find out that, for example, October of last year to October of this year, if we keep going up on the trajectory we're on right now, we're not going to see a 3% inflation rate. We're going to see more like 5 to 8% inflation rate, far from the 2% that was kind of the mandate before they stopped dropping interest. So, when they say, oh, we're still going to have interest rate decreases, they're not going to do it because inflation pressures cannot allow them to lower interest rates. They're going to continue to have the same meetings that give you optimism that, oh, they're coming, just not right now. Oh, we might have to just live with, higher for longer, but don't worry, it's coming. And every time they say it's coming, oh, there's going to be another rate decrease. Well, what about the 7 that they've already priced into the market from last year that haven't happened yet? So now we're pricing in an 8th one, but they act like it's the first one that they're pricing in. So, well, definitely we're going to have some rate decrease. Well, what about the earnings this year? So if the market's up 20, 30, or 40%, and we're looking at, what fair valuation is from a price earnings standpoint, historically it just really hasn't been this high. We're in the top decile. It's only been this high a couple of times. Stocks are overpriced historically, just like they were right before the .com bubble burst. We are in an AI bubble like nobody's business. I mean, they're acting like, this AI business is going to affect every company and just go to the moon, just like the .com hype was. It reminds me of the same days. And I was alive and well in this business back then. And this is just the same gut achy feeling that I felt then. And only this time I'm a little more gut achy because I remember how it ended. And then there was the bank crisis in '08, kind of, that was a lot of hype there too, with houses and building and real estate prices going out of control, interest rates going down, making it easy to borrow with zero interest or interest only loans and all these things. So we've been through the cycle a couple of times where there's been extra hype. And I think we're at the same point right now. And in order to keep milking or keep pushing that hype or that narrative and continue to prop the market up, and I think it's strictly because of the election. I don't think it's really an economic benefit to anybody to stretch the rubber band and just have the bubble get bigger and bigger until it pops harder. It's just going to leave, a bigger disaster to happen when it finally does. But, rate hikes, I don't know that they'll have any rate hikes, especially with the election coming. I think in order to get and I've said this before, in order to get inflation more under control, it probably wouldn't be a bad idea. A recession means a reset. There has to be a reset because where we're at is not sustainable. It just isn't. It's going to end badly. History says it will. And just these stats and some very smart economists say it should end badly. A lot of the hedge fund managers are taking defensive measures. When the dollar was starting to fall, gold and silver started getting really hot. Now that other economies like China and Europe are not as strong as we thought they were, the dollar's getting a little stronger, which makes gold maybe a little less attractive. We're watching what the hedge fund managers and the smart people are doing, and they're preparing. They're loading up on bonds, even the long-term bonds that, have been in a long-term downtrend for a couple of years, and even a midterm downtrend. They finally started up again. But these people that are used to hedging and managing billions and billions of dollars, maybe even hundreds of billions of dollars, they're doing things with their money different than what the news is telling us to do with ours, or you to tell, the listeners are probably just hearing all this hype. Oh, the market's going to the moon. It just can't go down. It's different this time. Well, those are the most dangerous words in the market. It's different this time. To answer your question, I don't see a rate decrease happening unless there's recessionary pressures. Now, given that, there is recessionary pressure starting to creep in. Inflation not only is still kind of on the upswing, even though from a month. So when a year-to-year inflation doesn't look good, they go month to month. Like, retail sales, they only went up marginally at 0.1%. We thought they were going to grow at 0.2%, but they didn't grow that much. From last month. Well, that's retail sales. That means actually retail sales are down. Well, that's interesting. So people aren't spending money like we thought. Inflation. Well, based on from last month to this month, wasn't that bad? Well, it's almost the same. Well, okay, so what? What is it really doing to the consumer? We're already up 25% overall since this problem started happening. It's not going backwards. We're still adding, even if it's 2 or 3 or 4% to it, we're still adding on top of that, making things harder and harder for consumers to purchase goods, buy houses, rent apartments, all these things. We've seen car sales go down. We saw unemployment go up over 4% for the first time since I think it was early in 2021. The other thing is that the job openings have been at the lowest level since that same time, February 2021. And that was just right, when COVID, shut everything down, right? That was just kind of just a few months after we had the lockdowns. And we're back there again to where we're not seeing the hiring. So given this full circle of your question is, do I see rate cuts? Not because they're just a benevolent Fed and they want to keep the market propped up. I think they would love to do that. I think the rumor is doing that all by itself, along with all the other manipulative tactics that they're using, and the propaganda machine, the news, is telling us. And one other factor that is very concerning as far as recession issues is the breadth. There's a breadth curve that talks about the breadth of the market, meaning not bad breath. It's bad breadth, as in how wide the range is. And I think I can find a chart here, if I'm not mistaken. The breadth, there's been a couple of times when there's been far more stocks go down than go up, even when the long-term trend of the market is up. And it's kind of an interesting phenomenon that happens. And it happened right before the dot-com bubble, where we had more stocks going down and only those few hand-picked stocks that were actually on the move on the upside. And if you look at where we're at now, just in the last couple of months, we had the S&P go up. Just last week, there was, I think it was 450 stocks that went down. There's over 400 stocks that are below their 50-day moving average. So the trend is down for more stocks than the stocks that are trending up, yet the index is trending up. That is not a good sign. That is an incredibly bad sign, in fact. it happened again, like I said, in 1999, and it just happened again just now. I've talked about the inverted yield curve. The inverted yield curve says when short-term interest rates are higher than long-term interest rates, which doesn't make any sense, then we're going to probably see a recession somewhere between 1 month and 2 years out. Well, we are actually officially in the 23rd month of the yield curve inversion, which happened, obviously, if we go back 2 years, roughly end of June, July-ish of 2022. So even though the median time frame is 11 months, I saw a stat said 14, but let's just say it's half that time. Well, that's fine. Some of the times it happens quickly and sometimes it happens long. So in the last 75, 80 years since they've been tracking this, they haven't had a inverted yield curve not followed by a recession. So we're stretching the rubber band. We've gone as long as it ever has gone before, but it doesn't mean this can't be the longest one. I mean, the 23 month was the longest when it happened. So maybe it's a couple more months down the road. I don't think it's going to happen this month. So I don't think we're going to be within that. But does that mean we're not going to have a recession? I think some statisticians would say, oh, look at history. It always happens between these time frames. It's 8 for 8, but number 9 isn't going to happen this time because, we just got past the 23rd month. I don't think that that's the case. I think the government and the Fed has been a little bit more aggressive on the way that they've been able to manipulate this market in the face of propping up banks and injecting liquidity kind of through the back door, so to speak. But if we look at the trend lines right now, as we just had the breadth line, more stocks going down at the same time as the market goes up. So yeah, the inversion curve, I'm just looking at the chart right now. The inversion, we're exactly 23 months right now. So, history says, should it happen? Well, is everybody obsessed about a recession? I think most people say, well, gee, the market's up, so there can't be a recession. The market is something that doesn't necessarily have to track the economy. However, if the economy fails, then I think the market usually reacts in a negative way. So I think there could be a recession that could require a rate decrease. I don't think that they're going to do it if the economy stays roughly or appears to be stable like it is. But if you talk to most people out there, most people are a little concerned that it's not really that stable. There's a statistic, I think you have it, that 85% of the people are scared of losing their jobs this year.
Yes.
And there's been a lot of layoffs of big companies. That doesn't bode well for a good economy. That sounds recessionary to me. I mean, so why do we keep on talking about they're not going to be a recession? Everybody's spending more on housing, spending more on everything. Inflation's still going up. All these pressures are recessionary in nature. So I think what will happen is if there are going to be 2 rate decreases, it's going to be on the back of some bad economic news. It could be even a geopolitical event. It could be something that has to do with the election coming up, or, maybe something happens with the candidates of choice change out somehow, whether it be Biden, they decide he's too ill to serve and they put somebody else in there and it rocks some markets or rocks something, or it could be more wars in the Middle East. It could be an escalation in Israel. It could be a number of things that would be a trigger to cause a little bit of a sell-off and a panic. And if that happened, I think the Fed will jump in right away and do, okay, it's time for that rate decrease we've been promising. Well, what, 1 maybe, 2 maybe? Is that going to be enough? I don't know. When the economy was growing from the 2008 crash up to the COVID, shutdown, the interest rates were hovering between like the 1 and 2 mark, almost 0% interest from the standpoint of the bank's short-term interest rates. So when you're looking at that kind of a growth in zero interest, yet we're still getting growth with no earnings and higher interest, then it's really just a liquidity issue and it's a manipulation. So I think eventually we're going to run out of tricks to play. And I think the market's going to have to probably react negatively, and the Fed will come in and the Fed will jump right in to save the day. And then what's going to happen? We're going to get inflation again next year. So they've really kind of put us in a place that's in a rock and a hard place. I'm not trying to give everybody the heebie-jeebies. I'm just saying, it's important to not be in a position where this market craze could get you suckered in at the last minute just before it crashes and you lose a boatload of money. Now, if you've been in it with some of your money all along, then great. Maybe it's not a bad idea to take some profits along the way. But I wouldn't necessarily be getting in the market. There's a few sectors that I think look a little promising. Maybe the precious metals as a hedge possibly, and maybe bonds as things shake out. But if the market goes into recession, there's one of those kind of global events that triggers fear, then all bets are off with any asset class. So again, it's all about safety, protection, being smart, not having too much exposed to risk, making sure that, especially if you're, our typical client's more the retiree or the preparing to get retired, is you can't sustain huge losses. You've got to, plan on that income paying your bills, because those are the most important things. Not how much wealth can I leave my kids when I die if I do this right? Can I ride this thing out? Well, if you need your money along the way, it's a different story. So again, take the market with the respect that it deserves. Look at the situations that's happening. We're in some kind of unprecedented situations as far as where we're at in the market. I'll just give you a couple of stats really quickly here. The average price earnings ratio, the current price earnings ratio based on current earnings, from 1909 to 2022, we are in the most expensive 10%. It's at 35%. Now they're talking about, AI, forward price earnings. We're extrapolating today's value of stocks based on what they think might happen in AI. Yet we go back to earnings. Last year I mentioned they're less than 1% for the year. This year they were expecting to be somewhere between 4 and 5%. How does that justify 20, 30, 40% growth in the stock prices when earnings, in the index, when the earnings are a fraction of that? It seems like we're getting, pushed a little bit overblown here. If you look at the probable S&P returns over the next 0 to 6 months, according to statistics based on where we are on this high current price earnings ratio, and not what we expect or what people say might happen next year or the year after, is, we're looking at a 0 to 20% correction possibly. And we're looking at the median PE between all the companies is 26.5. I mentioned 35, that's overall. 26.5. Fair value is 17. So what does that mean? It means about 31% price decline is needed in order to get to fair market value. And by the way, fair market value is always, so far in history, it has always returned eventually to fair market value. If you look at a 31% decrease, that's basically a third. So you'd have to have companies who would have to roughly double their earnings or have at least a 50% increase in earnings in order to get to the fair value today. So it looks like we're either going to be stagnant in the market or we're going to have a correction, get to fair value, and then we'll have a nice entry point to grow again. But I wouldn't be too excited about those rate decreases yet, unless there's a recession. If there is a recession, that's kind of a bummer. But if you've been holding out to buy a house and you have a bunch of money saved and you're not losing it in this next market pullback, if interest rates do go down, maybe it'll be a great chance to buy your new home at a reduced level, because chances are prices of homes, prices of stocks, and prices of a lot of things are going to retrace a bit. So anyway, don't take everything as negative news. There might be great opportunities to, as long as you're not losing along the way, great opportunities to purchase at more realistic values and things that are more fair valued in the future.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about the possibility of rate cuts. Initially here, earlier in the week, we thought that we would have a rate cut in September, maybe another in December. But Jeff says, hey, hold on, that's maybe not going to be the case. If you have questions of Jeff about the market and the economy and how it may affect your journey towards a confident retirement, again, as every week, we're offering you the opportunity to come in and sit down with Jeff on a one-on-one basis and to ask the questions that you need the answers to put you on a path towards a prosperous retirement. We call it the Premier Retirement Roadmap. In order to get yours, call 520-780-9059. There is no cost for this whatsoever, and there is no obligation. You're listening to the program today on the weekend. That's okay. Go ahead, give that number a call, 520-780-9059, while you're thinking about it. What'll happen is Shelley will call you back during the week, and she'll set up an appointment for you to sit down with Jeff on a one-on-one basis and ask the questions that you want the answers to. Once again, there's no cost for this. There's absolutely no obligation whatsoever. Don't worry that you're going to get in there and sit down and Jeff's going to try to sell you something. That's not the way we work here at Premier Retirement. We have to know who you are, what your goals, your dreams, your hopes, and your visions are before we can even suggest a plan for you. So once again, you have a friend in the financial services business right here in Tucson and Mesa. 520-780-9059 is our telephone number. Make that call this weekend and set up your appointment. You can also find out more about us online at premret.com. It's PREMRET.com. Jeff, we're going to take a quick break. When we come back, my favorite part of the show, will answer listener questions and more when Premier Retirement continues right here on 790 KNST, Tucson's most stimulating talk.
Hi, this is Jeff Vogan, founder and CEO of Premier Retirement Planning and Wealth Management. We're in the financial planning business so you can be in the let's have fun and not worry about your retirement business. It makes no difference to us whether you want to hang out with the grandkids, go back to school, start a new career or hobby, or spend your retirement partying in the Caribbean. These are your choices. Our mission is to help you protect your life's work and turn it into a predictable income plan to finance the things that make you happy. Premier's investment philosophy is simple. Protect and manage your savings. Create strategies that seek not only to provide an income stream you can count on, but to grow your principal to keep up with your lifestyle. Retirement the way you want it. Finding the right partner that really understands you and your goals could truly shape your life for the next 30 years or more. So call us at Premier Retirement Planning and Wealth Management for a complimentary, no-obligation financial review at 520-780-9059. That's 520-780-9059. Or visit us online at premret.com. That's PREMRET.com.
Investment advisory services offered through Premier Wealth Advisors, LLC, and Arizona State Registered Investment Advisor.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shea.
We so much appreciate you joining us each and every weekend for Premier Retirement with Jeff Hogan right here on 790 KNST. Of course, we're on the air for you 4 times a week on the radio. Saturdays at 7 a.m. Also, we're on at 9 a.m. on Saturdays, also 1 p.m. And then on Sundays, we're on at 11 a.m. So you've got 4 chances to hear us on the radio. But if those are not convenient times for you, or if you've heard the program, you want to hear it again, or you missed part of it, we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and many of our past shows. As a matter of fact, almost all of our past shows there, so you can hear them on your own schedule, and you can get the answers that you need to put you on a path towards a confident retirement. Okay, Jeff, time for listener questions. We'll start it off with Mike, listening to us in Tucson, and Mike says, I'm 68 years old. I'm married and have been retired for 3 years now. I'm making $12,000 a month after taxes from 2 separate government pensions and Social Security. We have about $500,000 in savings and our 401k. We have a very low mortgage rate of 2.25%, which has a balance of $100,000 on a $600,000 house. We want to pay off the mortgage with funds from our 401k. After paying off our mortgage from the 401k, we'll sit until we're required to begin taking RMDs in 4 to 5 years. Our 401k is sitting in a fund that mimics the S&P 500. Are we following a sound plan, do you think? And would you recommend doing something differently than what I have in mind here?
Yes, I would. Don't pay that 2.25 mortgage off. You can park your money in a money market and make more on it than that. And the caution that I would throw out is, remember that when you pull money out of a 401k, it's taxable. So you're already in the 22 bracket. In a couple of years, that'll be the 25 tax bracket, and you're going to push yourself into the 24 bracket on a lot of that $100,000 based on your income. So if you're doing $12,000 a month after taxes, you're probably paying 30 or 40 in taxes, probably 30-ish. So your net income is already 150. Now that'll put you up to 250. That means about half that money is going to be, you're going to be taxed on about 23 plus maybe 3 or 4 for state taxes and other things. So you're going to have to pull out about $140,000 out of your 401k to pay off a $100,000 mortgage when you could be making more money in that 401k. If you want to pay tax now because you're worried about the RMDs that you're going to hit later, which you talked about the RMD starting in 4 or 5 years from now, that's true. And if that 401k money, the $500,000 in I don't know how much is in the 401k. You said 500,000 in savings and our 401k. If you're going to do anything, if it's savings making 1%, you want to pay off that mortgage, I'd rather do it off of that and not have you pay a tax. If you're going to pay taxes on that 401k money, I'd consider a couple of things. One, if you're healthy, you're 68, probably alert might be borderline, but you could convert that 401k money to a Roth over the next couple of years, pay taxes at 24% max, and then not pay tax at 25 or higher, or actually you'll be in the 28% bracket after the Trump tax cuts go away in a couple of years. So if you want to pay tax now at 24%, I think that's a wise idea to take that money out, but I would either convert it to a Roth, put it in a LERP. But that 2.25 mortgage is such a sweet deal. You're not going to see interest down there again, probably for a few years anyway, maybe several years. So as long as you can make more money on your money, especially even if it's in a Roth tax-free growth, that's more than covering that 2.25 mortgage. You only owe $100,000 on it. It's going to be paid off. Probably with just the extra cash flow you're making on the $12,000 a month. Mm-hmm. If you're not spending every penny of that, obviously you're probably not, because otherwise you'd probably be using some of your 401k money to live on instead of waiting 5 more years to take it on a required minimum distribution basis. After you're probably done having fun and don't need the money, then you're going to be sitting in a higher tax bracket, forced to take that money out. Then what are you going to do? Put it in a mutual fund or something that'll basically spin off more taxes as you go. So your tax problem is just going to get worse and worse. I don't think that you ought to make it worse right now in a lump sum withdrawal just to pay off a 2.25 mortgage. But if you want to get out of that future tax problem, which I believe is a wise choice, consider paying taxes now, or consider, if it is in the stock market, you said the S&P 500, based on the last segment of the show, there's a lot of consensus that we're not going to have a recession. But if you look at historical valuations, we should have at least a 20% pullback on the S&P. So if that happens between now and the end of the year, and I think it probably will, if it happens at all, it'll probably happen in the next 6 months, you might get a chance to do those Roth conversions later in the year, when the market's down. But I wouldn't necessarily think that that's an advantage. If you want to keep it in the market and that's where you want to be long haul, then, take advantage of the dips by doing the Roth conversions at that point. If you want to say, you know what, I don't really need any income. I've got the great pension. I don't really care to lose any money. Maybe I could use some of these principal protected products that, grow at 6 or 8% or so, which is probably more than the S&P. If you look at the current valuations of the S&P 500, his history says that over the next 10 years, we're going to average somewhere between 0 and maybe 4% average annualized rate of return, annualized. You could probably do better than that in principal protected products, because what that would indicate is there's going to be some corrections along the way. And there always is. When the market's valued this high, there's going to be some corrections, if not a crash, a couple of corrections like we had in 2022. That was a little bit more than a correction, but at the same time, it was a significant pullback. We still haven't had the earnings or the fundamentals to support where the market is now. So I think, additional pullbacks are probably in order. So to make a long answer out of this fairly concise question, although there's so many variables to it, there's so many ways you can go. I would, first of all, decide how you want that $500,000 to invested, what you want it to be worth for your retirement. If you want it to be your rainy day nest egg money, if you want it to grow without risk, if you just don't want the headache, or if you like the adrenaline rush of watching the market zoom and you're okay with the gut ache when it retraces and it's long-term money and you're never going to use it anyway, except for required minimum distributions and pay taxes as you go, then maybe it doesn't matter. But I don't know how emotionally you are connected to that money. I know the last decade or so has not been too bad for market-related assets. The next decade might be a little different. It might be like the lost decade of 2000 to 2010, maybe where it's a little bit bigger of a roller coaster ride. Maybe you're less apt to handle that nowadays than you were 10 or 15 years ago or 20 years ago. So, keep those things in mind. I think there's a lot to consider, and I wouldn't really be able to give you my final answer, obviously, until talking to you and learning more about your goals and what other options and what the split is between savings and the 401k. If all you have is $100,000, maybe just a one-time whack-a-mole and pay the taxes out of your savings rather than the 401k, maybe you're okay there. So if paying off that mortgage is more of a peace of mind issue and worth more than the interest you can make on an arbitrage, meaning you can invest at 5% and pay 2.25% and actually make money on that mortgage, then go with the peace of mind if that's more important. If math rules, like it does for me generally, is I'd rather keep a low interest loan and make more money on it, especially if I can guarantee it, or have a very, very low risk alternative. So anyway, those are my takes on that question. Hope that helped.
Mike, thanks a lot for listening to us in Tucson. Of course, we'll be sending you out Jeff's book, Retirement, The Road Ahead. And again, it would be a good idea to sit down with Jeff on an individual basis, Mike. Our telephone number to get that appointment, 520-780-9059, 520-780-9059. Jeff, I had a question about these mortgage rates. He's looking at 2.25%. You said it's going to be a little while until we see those rates again. Do you think we'll ever see mortgage rates in our lifetime that are going to be down at 3% like they were?
Well, if we have a big enough recession and have to do basically the same things we had to do in 2008 when the banking crisis killed everything and we started printing money, we could drive it down again. Sure, the Fed could do that. I think they might want to do it. The problem is there's so much liquidity out there. It's going to create so much inflation. It'll be crazy. So we might get a 2% mortgage again, but that $600,000 house is going to be $1.5 million perhaps. Right. So the payment's probably still going to be more. So it's going to be all relative. I would not rule out seeing those rates again. A big problem with just where the economy is, and we can talk about that maybe in the last segment today, is just how much debt has to be refinanced, and the current rates are higher. So in order for the government to refinance the bond debt from the printed money at lower interest rates, they're going to have to refinance at a much higher interest rate. And if you look at the numbers, we're going to just dig that debt hole even deeper and deeper and deeper. So there has to be some sort of a reset, probably some sort of monetizing the debt. And I hate to talk those terms because that kind of reminds us what the pigs countries did about 20, 25 years ago, Greece, Spain, Italy, and Portugal. Remember the pigs?
Yeah.
they had a reset. Everybody lost money and it just kind of started over. And now they're in world of debt again. And, we're finally getting there the first time, but I don't know how to do that without resetting. So if that's the case, they monetize the debt. They want to refinance at lower interest rates. They could force the interest rates down again, but it would be in the face of a huge economic, I don't want to use the word catastrophe, but it would be economically bad for a lot of people. It would hurt, but it might be kind of like ripping the Band-Aid off, one of those things that needs to happen. Again, cycles happen. Again, not doom and gloom. We're just at that point where everything's in a bubble and we have to be ready for it. And when they pop, then we regroup. And it's America, man. We just go and we fight and we dig back in, we reinvest and we reallocate and we rethink our plans, make sure that we're on the right course. Better yet, we have a plan that'll weather the storms so that when those things happen, it doesn't cause us as big of a headache. It doesn't ruin us financially. We have to actually start over, especially if we're in retirement. So again, a sound plan will help, but getting the ducks in a row for all these things that will probably happen are just equally as important. But I don't think interest rates can, just because of where we are in the debt issues and the credit cycle, I don't think, barring just massive inflation that we have to curb with massive rate hikes, I guess it could happen. I mean, look what happened in the early 80s when interest rates were 16 and 18% because the Jimmy Carter era, when stagflation and the gas shortages, just less than a decade before all that started, we had to kind of dig our way out of a hole. And that caused some grief for people that needed to borrow, but it got us kind of back on track to where now, as interest rates fell from those levels over the last 40 years now, we've seen bonds increase. We've seen people be able to afford more things. We've seen the economy be able to grow. So I don't think it's a bad thing if interest rates do decrease. I hope they don't have to increase. But again, it kind of depends on what it does to inflation. And sometimes we have to keep the whole picture in mind.
We're answering listener questions with Jeff Hogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And once again, our phone number is 520-780-9059. Okay, Jeff, next question is Kate, listening to us in Suarita. Kate says, I'm in my early 40s and I've worked myself into a sad state of health with the stress of running my own business for 15 years. In April, I pulled the Band-Aid and sold my shares for about $130,000. I have $150,000 left on my mortgage with a 7.3% interest rate. I'm setting aside $20,000 my windfall for taxes, using $15,000 as income over the next couple of months. So what would that be? $35,000. And I put the remainder of the first installment into a high-yield savings account. The second installment comes the end of June. The rest will be completed by the fall. Some friends have suggested that I just throw the money at my mortgage to get debt-free and dive back into the workforce, as I have potentially high earning potential, especially if I take another high-stress job. However, I think it can be leveraged to get me in a better financial position for my future. I'd love to get some advice on ways to take advantage of this opportunity. I'm open to any and all ideas and suggestions. So after all is said and done, she's going to have about $100,000 left.
Well, if that's all the money you have left, Kate, I would be scared of. I'd rather have a mortgage and some cash than no cash.
Even at 7.3%, though, right? No?
Yeah. Here's the thing. I mean, I would love to pay it down. I think, as stressful as the business was, maybe a job is less stressful. Maybe you do a part-time thing, so you're only half as stressed. But I just think it's bad advice to have zero cash for emergencies. And it sounds to me like you'd be right about there, zero cash for emergencies. If you've got $150,000 left on your mortgage, you can't even pay it all the way down. Maybe if it's a cash flow issue, and I don't know. I mean, you're in your early 40s. I have no idea what other assets you have to live. I mean, are you married and have a spouse that makes all the money you need, or sounds to me like it's your mortgage and
single person probably. Let's just assume that.
So given that situation, I have no idea. I understand selling a high stress business. I was high stress in my 40s. I'm glad I hung in there. Now I'm not, but I get that, man. I was on the verge of selling and just going back and get a regular job. I think my life would have been maybe a little less stressful, but I can't imagine just thinking about that, having no money in the bank for rainy days or paying my bills. Because, without a mortgage, I mean, if you don't have a mortgage, but you can't buy food or gas because you're not working, that'd be kind of tough too. So maybe you just use the $100,000 to continue to pay that mortgage. I don't know what the payments are, probably, $1,000 a month or so, maybe a little bit more, plus interest. So, I mean, you might have a few years of staying power if you just, live kind of low key. Maybe you just regroup and start doing some part-time work, maybe looking for your options, maybe even build another less stressful business. I don't know. But in your 40s, you got, if you're going to live to you say just stats say to health, I hope that didn't limit your life expectancy other than just the stress was getting to you and you had to change focus. Maybe just finding a low stress job where you just come and punch a clock and just do some busy work and get paid something to pay the bills. And maybe you downsize. If you've got enough equity in that house, maybe it's a $500,000 house, and maybe you just buy one free and clear and keep the 100. I think that'd probably be the way I would get out of my mortgage. You're not old enough to do a reverse mortgage and have that mortgage paid off for you and, get rid of that payment. But, I see you without a job and a business and a mortgage payment being a bad thing. But then again, I see you with no cash being even a worse thing. So I don't know. I don't envy your position. I guess I envy it if it's a stress reliever, but I think you maybe take the time off to heal, spend some of that money on you, and then reset for another 20 years and retire in style. That'll be my plan.
Katie, thanks for that question. And remember, Starbucks needs baristas too. So there's a low-stress job for you that could be fun. We appreciate you listening to us. And of course, we'll send you out Jeff's Book Retirement the road ahead. Once again, our telephone number, 520-780-9059. It's 520-780-9059 if you want to sit down with Jeff and have a private conversation about your journey towards a confident retirement. No cost and no obligation for that retirement roadmap. Okay, Jeff, our last question for this week is Vicki listening to us in Oro Valley. And Vicki writes, what are the options for an elderly person to leave money to an adult child in her 50s? Let's call her Mary, who's been completely financially irresponsible, including being homeless at times. Would an annuity purchased upon our death make sense, or a trust? Who should be the executor of the trust? She should at least have a roof over her head as she ages. And we're talking about an inheritance of $500,000. Many thanks from Vicki.
Well, I'm sorry about, everybody has kids of different financial abilities and different abilities and everything. Some people, are great athletes and can't manage money. Some people can't throw a ball, but are Elon Musk and make an electric car company and be a billionaire, a trillionaire. Right. Everybody has different talents, and I'm sure she's a great person. I think trying to make sure she's not homeless and has a roof over her head is an awesome goal. I do favor annuities for that. In fact, there's a couple of ways you can do it. One is just keep the money in a trust and have somebody portion it out and sort of burden the trustee with that. But some trustees, especially trust companies, will charge a hefty fee for that, and they also very often mismanage the money. I hate to besmirch the name of all the trust companies out there, but honestly, I'm skeptical about their ability to keep your best interest in mind, even though they are considered fiduciaries. Here's one thing I would suggest is consider an annuity. You can actually put some of that money, if you already have it. I don't know if it's just money from a house or money from your 401ks or whatever, but you could put whatever is liquid or investable in an annuity that is deferred, even at a fixed interest. Right now, you get long-term fixed interest at 5% or better, which is pretty good. It might not stay there for very long. It might come back down a little bit. Could go up too, but you could defer that annuity until you pass and do what's called an irrevocable beneficiary designation and a distribution designation, where you say, this is my beneficiary. She gets a 20-year payout, period. And the payout would be principal plus interest till it's gone. That would give her at least enough money to probably get her at least to Social Security age, retirement age, RMD age, if she ever has anything in our, if she doesn't end up saving some money in a qualified type plan. But that might be the way to at least, get her from first base to second base, maybe even third. Not sure it'll get her all the way home. Or you could even do a lifetime annuity, $500,000 in lifetime. I mean, it might not be more than about $1,000 a month, but again, it's at least food. Probably not enough to make a home. Maybe $2,000 a month would be more likely to, if you did like a 20-year payout, something like that. I'm just kind of ballparking the numbers here, but you could also put the money in a trust, or just put a trust together so that a trustee, somebody like a sibling or a brother, brother or sister of yours, or somebody you trust, or maybe even another one of your children, would be assigned to put that money into a 20-year payout annuity. Then they would just shop the rates at that particular time. I do have some clients that have that, and their trustee is supposed to, they don't have to use us, but I assume that they'll probably call us and say, hey, what are our best options in an annuity when I die? And because they did their trust with us, we review it commonly, and they also own all their present annuities and other assets with our firm. So it would be really easy for that trustee to say, hey, Jeff, the trust says I'm supposed to put everything in a 20-year annuity for the 5 of us heirs. Can you help us? And the trustee just gathers the assets and we fund it. So there are some easy ways to do that where she would not get a lump sum of $500,000 to either blow it on something or mismanage it and have 3 or 4 good years and then be homeless again for the rest of her life. So Yeah, I think you mentioned the trust and annuity. I think that's how you'd possibly use those together.
Vicki, thanks so much for listening to us. And of course, we'll be sending you out Jeff's book, Retirement: The Road Ahead. If you've got a question you'd like us to answer on the air, you can get it to us by going to our website, which is premret.com, PREMRET.com. Go to the contact page there towards the top, put your question in there. And of course, if we use it on the air, you'll get Jeff's book, Retirement: The Road Ahead. It is that simple. You're listening to Premier Retirement with Jeff Hogan. Glad you could join us in this fine weekend. Of course, we're on the radio for you 4 times a week. We're also a podcast. Don't forget that. All of our shows are on that podcast. Or if you go out to premret.com, our radio shows are there too. We encourage you to visit premret.com. We've got a great website going for us there. We've got a couple of webinars up there. Also some resources you can take advantage of. And when we do have seminars, we'll talk about those as well on the website. Once again, it is premret.com, PREMRET.com. Jeff, early in the program, we were talking about the latest layoffs and firms making cuts. And as a matter of fact, 85% of workers, that's a staggering number, said that they feared being laid off in 2024. What's your opinion on that?
As I was talking earlier, talked about, if the Fed is going to lower interest rates, it's going to be in the face of a recession, not in the face of lowering inflation, because inflation is not coming down, even though they claim to have better numbers. The report that is staring me in the face is, Microsoft is cutting an unspecified number of jobs. Nike's cut it also unspecified. Lucid's cutting 400. Of course, that's an electric car maker that, hasn't really got its feet under it yet. TikTok planning on laying off more employees. Disney Pixar, 175 jobs, or 14% of its workforce. That's a pretty big jump.
Yeah.
We've got
Walmart.
Spirit Aerosystems, 450. Walmart, they're reducing.
And its corporate workforce, yeah. And Indeed is another one. Wow, this is an interesting
Isn't
list.
that interesting? Indeed, 1,000 employees. Okay, so how's the job market strong if Indeed doesn't need its employees anymore? 8% of its company. That's because job availabilities are lower. Vacation companies are laying off their companies. Peloton, of course, they're almost out of business. They were on the list. Google, 200 of its core employees. Yeah. And they're hiring replacements in India and Mexico. Isn't that nice? Outsourcing that stuff. Tesla laying off hundreds more staff, including its entire supercharging team. And that was just after a few weeks ago, they cut 10% of its workforce. Bristol Myers, wait a minute, really?
Really?
They're trying to cut costs by $1.5 billion. 2,200 jobs, Bristol Myers. Holy smokes.
Oh, my gosh.
The economy's good. I understand. People are a little worried. And these are not just minimum wage jobs. These are not barista at Starbucks jobs, right? These are real jobs. Lululemon, whatever you call them.
Apple is another one that laid off 600 employees after.
Well, they did. Their stock's booming because they say they're getting in the AI business. Again, it's just hype. Right. Rivian laying off 1% of its workforce. Who was that other one? Fisker. They just filed bankruptcy this week. So they're out. And that's the second time that CEO has failed in an electric car company. I don't know why they keep giving him money to try it again. He doesn't have a very good track record. But there's a ton of people losing their jobs. I want to also, just before we quit, because I know there's some time limitations here.
Yeah, sure.
There is a very noted, and this is why I lean towards there's still going to be a recession. I don't try, like I said, it's just cycles. It's just like it has always happened before, and I can't see it not happening again. There's a very noted economist that has a newsletter and a following that doesn't give me the ability to say his name right now, but very noted economist. Anyway, he says, the consensus still believes there's decent world economic growth. He says, we do not share this view. China's struggling. They're heading into a major economic crisis. Europe is in an exercise in stagnation, and the U.S. economy is somewhat erratic and starting to slow. At some point, this slowdown will eventually trigger a major problem that will rock financial markets. More manipulation ahead of the U.S. election may be tried, but we expect those efforts to fail. So, that's a pretty interesting quote. And I think, this AI madness and a couple of things just in this article or talk this report that this person and his team gave is most important. There's going to be a slowing world and U.S. economy. And it's so highly leveraged that the implications are far more unpleasant than would otherwise be. So AI madness has created a bubble, which is on target with similar patterns we've seen in previous technological booms, namely the .com bubble. Here's one. We expect the divergence among equity indexes around the world to grow. In other words, they'll all be kind of different.
Jeff, I really hate to cut you off. So much information, so little time to talk about it. Let's continue this conversation next week. If Jeff's thoughts resonate with you, you want to get in and sit down with him, talk about your individual situation, your retirement roadmap. We're offering that right now for you, no cost and no obligation. It's an opportunity for you to sit with Jeff, ask your questions about the market, the economy, and your journey towards a confident retirement and what you can do and what you should do. Our telephone number, in order to get that, 520-780-9059 is 520-780-9059. No cost and no obligation. You can make that call this weekend, as in right now. Leave your name and telephone number. Shelley will call you back during the week and set up that appointment for you. Once again, our telephone number to sit down with Jeff, 520-780-9059. Make that call this weekend. No cost and no obligation for your complimentary retirement roadmap. For Jeff Ogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.